Advising Consolidated Edison on Solar Profitability. Group members Ryan Connors, Abinet Kassa, and Torie Nugent. The information from our project was gathered from data.gov by way of NYSERDA, or the New York State Energy Research and Development Authority. NYSERDA advances innovative energy solutions in ways that improve New York's economy and environment. It is a public benefit corporation, offering objective information and analysis and technical expertise to help New Yorkers increase energy efficiency and reduce reliance on fossil fuels. Our client is ConEdison, the utility company based in New York City, New York, and Westchester County, New York. Consolidated Edison has been a big player in the solar market since former Governor Andrew Cuomo began the NY Sun project. ConEdison has more than a decade of experience designing, building, and operating solar projects. The main objective of this project was to create a classification model to determine, based on the given attributes, whether a project is likely to be profitable or not. The secondary objective was to find if there were any natural clusters surrounding certain attributes that point towards profitability. The ultimate goal of our project was to advise ConEdison on which projects are likely to be the most profitable and why. The dataset was obtained on data.gov, but was compiled by NYSERDA, as mentioned previously. There were 120,000 records in the original dataset, spanning 21 years of data collection. These records included electric utility, program type, project status, zip and city information, and sector. The date range for this dataset was 12/21/2000 to 9/30/2021. Here you can see a cross-section from the original dataset. The attributes from the original dataset that we thought were the most useful for our project were county, electric utility, project cost, incentive, and expected kilowatt per hour annual production. Considering that our project was concerned only with ConEdison, we eliminated all other electric utility records from the data, leaving us with about 40,000 entries. In order to compute profitability, we had to determine the income generated from a certain project, its 25-year return on investment, and the total project cost. Once we had determined these factors, we were able to set up an if logical formula in Excel to separate those projects that returned above a 20% ROI and those projects that delivered below that benchmark. We calculated the annual income of a certain project by multiplying the expected annual kilowatt hour production by the average rate per kilowatt hour as determined by 10 years worth of average rates from NYSERDA. The return on investment was then calculated by taking the annual income per kilowatt hour, multiplying it by 25, and subtracting the total project cost, which is the project cost minus the incentive. The profitability, as mentioned in the slide previous, was a logical if formula in Excel. If the 25-year return on investment was greater than 20% of the project cost, then the project was deemed profitable, high. If it was lesser, then it was deemed to be not profitable, low. In order to find the average rate per kilowatt hour, we took 9 years worth of monthly rate charges and averaged them out to produce 18.3 $1.35 per kilowatt hour. From the provided data, outliers were omitted from the project as they caused errors in the data and made graphs very difficult to read. Missing values were either deleted, replaced with a 0, or left alone if there was enough information in other columns. As stated previously, our primary goal was to create a model that would work on the original dataset. In Excel, we were able to determine the profitability score by calculating the expected ROI, income, and total project cost. In a real-world scenario, we may not have access to these attributes, so we decided to build our models using the following attributes that were found in the original dataset, with the exception of profitability. The mining methods we utilized were the classifiers J48 decision trees, support vector machines, and the clustering model simple k-means. We decided to use these models after testing and trying out various models on our data. These models provided either the lowest error rate or the most compelling information. We created a J48 classification tree model to determine whether a project should be labeled high or low profitability. The model itself had 11 leaves and the size of the tree was 21. The model also had a TP rate of 0.845, FP rate of 0.172, precision of 0.846, and recall of 0.845. The ROC area was 0.879. The model was built with the intent of making it have a strong predictive ability without overfitting it to the testing data. We tested the data using 10-fold cross-validation. This decision tree model showed that projects with a low project cost and high expected annual kilowatt production tended to be more profitable than those with high project costs and low expected annual kilowatt hour production. We created a support vector machine model to gain insight into which attributes had the greatest weight when determining profitability. This model helped to show which attributes contributed to profitability in relation to one another. This model had a lower TP rate than the J48 decision tree at 0.64, and the ROC was also lower at 0.554. We tested the data using a 10-fold cross-validation. This model showed what we learned from the J48 decision trees, that the two most important factors were the expected kilowatt hour annual production and the project cost, with incentive and Kings County behind. Lastly, we created a simple k-means model to help identify centroid attributes that correlated with high profitability. We decided to test the data using a 66% split on the training data. The largest cluster, Cluster 4, contained 38% of the data and pointed towards Queens County, indicating a correlation between Queens County and high profitability. Of the 5 clusters shown, 3 clusters pointed towards high profitability. These clusters showed a lower project cost to incentive ratio, less than 7.5 to 1, indicating a correlation between lower project costs and higher incentives to high profitability. Our top findings were that the most significant factors for determining overall profitability are the project cost and expected annual kilowatt hour production. Projects with low project costs and high expected annual kilowatt hour production tended to be more profitable. Queens County had the largest cluster with 38% of the data correlating with high profitability. There was a correlation between larger incentive to project cost ratio, and high profitability. Our recommendations to ConEdison are to seek out projects with low project costs and high expected annual kilowatt hour production, to seek out projects in Queens County that meet the above criteria, to seek out projects with a high incentive to project cost ratio, and finally, when considering projects, the most important factors are the project cost and the expected annual kilowatt hour production.